Hi guys, this is Pragya. Welcome to my channel FINMOM. I try to make finance simple for you. Hi guys, everybody wants to be a billionaire or a millionaire or I don't know, a trillionaire. But everybody wants to be rich these days, and stock market is a glittering world where everybody thinks they can make money. Warren Buffett, Rakesh Jhunjhunwala or the infamous Harshad Mehta, what do all these people have in common? Stock market. They all became rich in the market. Some withstood with time and built their fortunes, became rich, stayed rich. Some did not. But everybody thinks that stock markets are the easiest way to make money. The number of people who are entering the stock markets is huge these days. And why not? Everybody thinks since they can trade, they will trade and they make money. Some lose money. But nevertheless, everybody is trying, and it is a good thing with the potential that India has and the Indian markets present, the Indian companies present. Everybody should get the benefit of it. Should we not? But why do people lose money? There are rags to riches story and riches to rags story, all in the same market. So don't you think before you become an investor, before you start your investing journey, you should know more about what actually the market is? What are shares? What are stocks? People think buying shares will make you rich. As we talk, Warren Buffett's net worth is 11,840 crores US dollars. That is what the market gives you. But if you stay invested, you're consistent, and you know what you're getting into. Most people don't. But those who do make money, and sometimes people who don't also make money. But before we go into all of that, let us understand what share is or what a stock of a company is. Share is the unit of ownership, a part of its equity or capital. So you see, every company has certain assets. It has buildings, it has land, it has machinery, it has working capital, all of that. So all of that is financed either through capital or through debt or liabilities or loans. So this capital can be equity share capital or preference share capital. Now, to understand what are equity capital and what is preference shares, I'll make another video. Here we'll talk only about equity capital or ownership, the capital which guarantees you a ownership. So every company has to have an authorized capital. Now, the authorized capital is the total amount of capital that it can raise during its lifetime. That authorized capital can also be modified. Now, authorized share capital can be modified during the course of the company, but let's just stick to authorized capital being the fixed capital for now. Now, out of that authorized capital, the company issues shares in the form of issued capital. So, let's say a company has an authorized capital of 10 lakhs, that is 10,000 shares of 100 rupees each. The company decides to issue 1,000 shares. 1,000 shares into 100 is rupees 1 lakh. So the issued capital of the company becomes 1 lakh. Now you must have seen the advertisements in newspapers for a lot of IPOs. A lot of IPOs happened recently, initial public offers. I'll be explaining that in the video. But IPOs are something where the company offers you their shares. So you must have seen shares of Zomato, Nykaa, and so many companies that came in the last few years. So those companies have offered shares at a higher price. Now you might see the document. It is clearly written. The face value of the share is 10 rupees, but the offer price is say 70 or 80 rupees. Now why the difference? So like I said, when the issued capital is 1 lakh, the face value of the share is 100 rupees. Since the company has a higher valuation, that is, the value of the company in the market is greater than what it is in the books. It might be because of goodwill, or there might be a demand for the sector, or the industry is rising. So in that case, the company offers shares at a premium. That is an additional amount that you pay over and above the face value. So The face value of the share might be 100 rupees, but the offer price might be 300 rupees. So 200 rupees becomes your premium. Moving on, as you buy shares, you become a shareholder. So if the authorized capital has 10,000 shares and you're buying one share, then your percentage becomes 0.01. Like that, when the company goes public and it issues shares, there are so many people who are buying, and everybody who buys the share of a company becomes a shareholder. They have right to vote, they have right to dividend, they have rights and obligations listed as per the Companies Act. So when you're buying shares, you become a shareholder. Now you will say that, oh, do I have the same rights as somebody who's holding 51%? Maybe not. It depends on the percentage of shares that you're holding. But the Companies Act is such that it protects small shareholders, because most people say buy 100,000 or 10,000 shares depending on the income or the investment amount. So you stay protected and you have rights to vote and dividend. Now moving on, how do you buy shares? Remember I said IPO? IPO is initial public offering. That is the primary place where you can buy shares, where the company directly sells shares to you. So in an initial public offering, you buy shares from the company. So every time there is an IPO, the Security Exchange Board of India oversees the IPO, and they generally put a percentage of shares for retail investors. Retail investors as in you and me, as opposed to institutional investors like mutual fund companies or wealth management companies and trusts and so on and so forth. We are retail investors, and for us there's always a percentage of shares that are offered, and we can buy them directly from the company. Now previously, when our parents probably used to buy shares, there used to be a share certificate. Now when you have the certificate, it grants you ownership of the company, and as you transfer the share certificate from one person to another, the person's name is written at the back, which shows that there's a transfer. If you ask me, it was too cute, but now we have demat accounts, and so we hold shares in dematerialized form. Demat account. If you have a bank account with any bank, you must have got a call asking you to open a demat account. In today's investing scenario, it is wise to have a demat account, because not only can you buy shares or trade in shares, you can also buy gold bonds and mutual funds and everything through your demat account. So it is wise to open a demat account. Primary market is when the company directly sells it to the customer, whereas secondary market is when all those people who hold shares trade in them. I might want to sell a certain amount of shares and somebody else buys them. If you are an investor or a trader, you already know this. You place an order to buy or sell, and the computer takes care of it. But what happens is the computer just matches sellers and the buyers, and that's how the trade gets executed. So to buy shares, you need a demat account, and you can directly buy shares in the IPO, or you can buy it from the secondary market. Now most people get bored with the amount of advertisement that happens, and they say somehow relate to the company. For example, that's what happened with Nykaa or Zomato. People know these names, they thought they're familiar with, and so the IPOs were a grand success. It's a different story that the value decreased, but nevertheless, that's how people relate to companies, and that brings us to the next section: how to invest in a way which gives you maximum returns. Now, I always refrain from giving you advice on where to invest. I just tell you the path. Which path you take depends on you. But these are tips that I have learned from all the experience that I've got in investing myself and looking at HNIs. So I'll just tell you a few tips. Firstly, know what you own. And this is something people don't do. If you are working in an insurance sector, you know the insurance sector. Why not invest your money in companies you relate with, or you know their workings, or you understand their financials? You would not know anything about a tech company, but you go and invest in a tech company because somebody told you to. So the first rule of investing that I feel is know what you own, or know where you're investing, because ultimately it's your money. Secondly, do not, and I cannot stress this enough, do not invest based on the herd mentality. Just because somebody else is investing, you shouldn't go and invest unless you're convinced that that is what you want to do. Just because your friend is investing in XYZ share, don't go and invest in XYZ share. Do your own research, understand what the company is all about. And that's the third point. Do your research. Just because a company has given good returns in the past doesn't mean it will give good returns in the future. Just because a company is trending now doesn't mean that it'll be, trending or it'll give you a good return. And just because some influencer told you that this stock will give you 300% return, do not invest because you do not know what the company is all about. Sometimes I've seen people, they invest in a share without even realizing what the company does, because somebody told them that this company will give them a good return. And honestly, personally, I have done that too. Even after doing the complete research and even after not being completely convinced, I invested, made a loss, learnt my lesson. So be intelligent and learn from my mistake. Do not invest in a company because somebody told you to without understanding what you're investing in. And the last point, and this is probably the best advice that I got when I began my investment journey. These are not my words, these are actually Warren Buffett's words, whose company is one of the highest traded stocks currently. He said, do not trade because you can. Got it? Do not trade because you can. Just because you can buy and sell shares with a click of a mouse, don't do it. Understand what your goals are. What are you there for? And that brings me to trading and investing. See, there is a difference between a trader and an investor. A trader buys and sells stocks. There are day traders who buy the same day, sell it off the same day. There are traders who do not even have the money to buy. They pledge their stocks, take some money off the market, invest again, and when they suffer a loss, they have to again borrow, and all that cycle. There are something people are unable to resist. They think they'll invest and they'll get twice the amount or 3 times the amount, and just overnight they'll become crorepati's. But to become crorepati's also you need to have some research. So if you are investing, be an investor. Depending on your investment goals, hold the stock. If you believe that you've bought shares in a company where the price of the shares is going to go up in the long run, then hold those stocks. Do not trade because there might be times when a stock goes up and then there is a downfall. You sell because you think that, oh, this is going down, so we sell, this is going up, so we buy. Market doesn't work like that. Investing doesn't work like that. You have to invest depending on your investment goals, and you have to hold stocks. So decide whether you are there for trading or you're there for investing. If you're there for investing, invest in a wise way, hold on to your stocks if you believe that they're going to do well in the long run. Don't sell or buy stocks just because somebody told you to. And lastly, see, everybody would think I'm a chartered accountant, I have so much experience, so I'll know all about the stock market. And I'll tell you this honestly, some of my friends who do not understand the market so well have called me and told me, oh, we just met this girl and she left her job, now she trades, and 2-3 hours she's earning 75,000, 80,000, 2 lakhs, 10 lakhs, so much money. What are you doing? Why don't you invest and earn money also? Why take so much pain to create content, write and all those things? They don't even pay. Go invest and you will get so much money. You are a chartered accountant. But you have to understand, even a chartered accountant has to do a research. Trading and investing are not so easy. So even though I understand the market well, I still do not invest all my money in stocks. I rely on mutual funds. Why? Because they're professionally managed. They have research, they have data, they have a whole team who's constantly analyzing and reading the markets, the industry, the sector, the company. Do you think the share price moves just because a company does well? No. The company is also affected by the industry, the sector, the economy in general, and anything and everything that happens. Even a war in Russia and Ukraine can harm your shares. But you think, oh no, I know everything. And that's one of the biggest mistakes that early investors do. They think that they know everything, but people who even claim to know everything know only a part of it. So I'd always advise, take professional help. See if you can get a mutual fund which is somehow aligned with your investment goals. You want short term, you want mid term, or you want long term. You want to invest in a particular sector or a particular company. Now there are customizable mutual funds available also. So take professional help. Try to invest in a way where whatever investment you're making is backed by some kind of research and not the word of individuals. That will be my advice for you to invest money in the share market and become wealthy like Buffett or Junjunwala. If I have missed something, please let me know in the comment section. And if you want to know more about credit cards or insurance, also let me know and I'll try to make a video on that. Please subscribe to the channel if you've not yet subscribed and hit the like button. Thank you. See you soon. Bye.